Okay, so when you're starting a business or even like a big project,
Hmm.
there are those big decisions right at the beginning that sort of set the stage for everything.
Right.
And the business structure,
Yeah.
that is a huge one.
Oh, absolutely. Yeah, it's like, you know, it's not as glamorous as landing that first big client or getting that amazing product out there,
Yeah,
but it really is like building a solid foundation for everything that's to come.
definitely.
If you get this wrong, it can have repercussions for years to come.
Yeah. And to help make sure we're all building on solid ground today, we're diving into a great book,
Right?
The Small Business Operator's Manual by Brad Poulos.
Yeah.
And we're really going to be focusing on this question of choosing a business structure and how it affects risk.
Right.
So think of this as your guide to one of the most fundamental decisions you make as an entrepreneur.
Yeah. And as Poulos lays out, there are really three main ways that most small businesses
Yeah,
get set up right.
right.
So we're going to be looking at the sole proprietorship,
Okay.
the partnership, and the corporation.
Okay, let's unpack those.
Each of them have their own little quirks and advantages and disadvantages.
And risks. Absolutely.
All right, so let's start with what seems like the simplest one on the surface,
Okay.
the sole proprietorship.
All right.
So what does that look like?
So in its most basic form, a sole proprietorship is an unincorporated business
Okay.
that is owned and run by one person.
Okay.
And so this is often the structure for people who are, starting a business from home or a side hustle, or if you're a self-employed tradesperson or something like that.
All right.
And you can operate under your own name, or you can, register a trade name if you want
Uh-huh.
something a little different. But it's basically just you doing your thing.
And it sounds like getting up and running is incredibly easy with a sole proprietorship.
It really is. I mean, if you're using your legal name, Polo says you're pretty much in business as soon as you decide you are.
Wow.
No specific registration needed in that case.
So let's talk about the tax man.
How does the tax man look at a sole proprietorship?
So with a sole proprietorship, the business and the owner are treated as one entity.
Okay,
So any profit you make from your business gets added to your personal income,
right.
and it's taxed at your individual rate.
Okay,
Now, interestingly, the same is true for losses.
okay.
So if your business is not doing well and you have a loss, that can actually reduce your overall taxable income.
Interesting.
So some really small businesses,
Yeah.
very small or hobby businesses or things,
Yeah,
they might start out this way because those initial losses can actually help them out.
I see. So simplicity really is the big plus here.
Absolutely, yeah.
Are there any other advantages?
Well, yeah, that simplicity extends to the paperwork,
Okay,
which can obviously save you money.
right.
And there might even be some initial tax advantages for really small ventures.
Okay,
So, it can be a good way to start and then think about incorporating as you grow.
right. And like sort of stepping stone.
Yeah, dip your toe in the pool.
Yeah, exactly. Now, there's a big downside to all this simplicity,
There is?
and that is liability.
Yes.
So talk about that.
Yeah, so this is the big catch.
Okay.
And this is something that Poulos emphasizes repeatedly.
Okay.
Unlimited liability.
Oh.
Because the business and you are legally considered the same entity.
Right.
Any debt that the business incurs,
Yeah.
any legal issues it runs into, that becomes your personal problem.
Uh-oh.
So we're talking your personal assets, your house, your savings, everything could be at risk.
Wow.
So if your business, if there's any kind of moderate level of risk,
Yeah.
this alone should give you serious pause.
You really have to think about that.
You do.
Yeah. What other things should someone considering a sole proprietorship keep in mind?
Well, raising money can be a lot harder
Okay.
as a sole proprietor.
Okay.
And some people might not see you as being as established or sophisticated as a corporation.
Right.
And then one really key thing is that a lot of government grants and programs
Right.
are only available to incorporated businesses.
I see.
So that can really limit your growth potential.
Okay. So, while it is the simplest way to get started, the risks might outweigh the benefits for a lot of businesses.
In a lot of cases, yeah.
Okay, well, let's move on then to partnerships.
Okay.
How do those differ from sole proprietorships?
So you can almost think of a partnership as like a sole proprietorship on steroids,
Okay.
where you have two or more owners instead of just one.
Okay.
And that lack of legal separation that we talked about with the sole proprietorship,
Right.
that's still there with a partnership.
And so what are the implications of that?
Well, it means that there's still that liability issue,
Okay.
but it can actually be even more complicated with a partnership.
Okay. How so?
Well, Poulos talks about this concept called joint and several liability.
Oh, yeah.
which basically means that each partner is responsible for all of the business's debts,
Wow.
not just their share. So
Wow.
even if your partner does something that you had no idea about, you could still be held accountable.
So your partner could sink you.
They absolutely could. Yeah.
And how are the, profits and losses split up in a partnership?
So when partners come together,
Yeah.
they'll usually agree on some kind of formula
Right.
for splitting those profits and losses.
Right.
It could be a 50-50 split, or it could be based on, their contributions
Right.
or their roles in the business or
Right.
any other arrangement they come up with.
Okay.
But just like with a sole proprietorship, they each report their share of the income or loss
Right.
on their own personal income tax return.
Got it. Now, the book also talks about limited partnerships and limited liability partnerships.
It does.
Can you sort of give us the quick and dirty on those?
Yeah, so a limited partnership or an LP,
Yeah.
that often comes into play with specific projects,
Okay.
like real estate or film financing or something like that,
Okay.
where you have investors who want to put in money,
Right.
but they don't want to actually run the business.
Got it.
So in an LP, you've got at least one general partner
Okay.
who's responsible for all the risk in the decision.
Okay.
And then you have limited partners
Right.
whose liability is capped the amount of money they put in,
Okay.
and they don't have a say in how the business is run.
So they're kind of silent partners?
Yeah, essentially.
Okay.
And, the profits and losses still flow through to the individual partners for tax purposes.
Right.
But it's really important to know that the rules for LPs
Yeah.
can change a lot depending on where you are.
Right.
So you really need to get good legal advice.
Always a good idea.
Oh, absolutely.
Now, what about limited liability partnerships or LLPs?
So LLPs are available in some jurisdictions for specific professions,
Okay.
like lawyers or accountants.
Got it.
And they basically limit a partner's liability for the actions of the other partners.
Okay.
So you're responsible for your own mistakes,
Right.
but not necessarily for your partner's mistakes.
I see.
But again, like with the LPs,
Mm.
it really depends on the specific regulations where you are.
Right.
So you really need to talk to a lawyer to make sure you're doing it right.
So all things considered, what's the advice from Poulos about partnerships?
Well, he basically recommends avoiding them in most cases.
Okay.
The main reason being that there's often more risk than even with the sole proprietorship.
Right.
Because you're not just liable for your own actions, you're liable for your partner's actions as well.
Wow. Got a lot of trust involved.
It is.
Okay, let's move on then to the third structure,
Okay.
the corporation.
Right.
This is where things get a bit more complex.
A little bit, yeah.
But it also seems to be where there's more potential protection.
It is, yeah.
So talk about corporations.
So the main difference with a corporation is that when you incorporate,
Yeah.
you create a brand new separate legal entity.
Okay.
So it's almost like giving birth to a new person
Okay.
in the eyes of the law.
Wow.
And that separation between the business and the owners is the key difference.
So it's like its own being.
It really is, yeah.
Interesting. And how do you do that? How do you make a corporation?
So you have to go through a formal registration process,
Okay.
either at the provincial or the federal level.
Okay.
And there are rules and responsibilities that come along with that.
So this idea of the corporation as a legal person,
Yeah.
what does that actually mean day to day?
Well, it means that the corporation has many of the same rights and obligations as an individual.
Okay.
So it can own property, it can enter into contracts, it can be sued just like you or I.
Wow.
But it also has responsibilities,
Right.
mainly to its owners,
Okay.
the shareholders.
Right.
And it has to follow all the laws and regulations that apply to it.
Okay.
So it has to file its own tax returns, it pays its own taxes, all that good stuff.
So even if it's a very small company, every corporation has to have a board of directors.
It does.
What is the role of the board of directors?
So the board of directors is kind of like the governing body of the corporation.
Oh.
They're responsible for overseeing the management of the company on behalf of the shareholders.
Okay.
So even if you're the only shareholder, you'll still need to appoint a board of directors.
Okay.
And the directors have what's called a fiduciary duty to the corporation, which basically means they have to act in the best interest of the company.
Okay.
Not necessarily in their own best interest.
I see.
So their responsibilities can include things like appointing the CEO,
Right.
approving budgets, making sure that the company is following the law.
Right. Big picture stuff.
Exactly.
Now, the source material mentions that directors in Canada can have some pretty significant personal liabilities.
They can. Yeah.
Can you explain what that means?
Yeah. So while the corporation does provide some liability protection,
Okay.
the directors can still be personally liable in certain situations.
Okay.
So, for example, if the company doesn't pay its taxes,
Oh.
the government can go after the directors personally to get that money.
Oh.
They can also be held liable for things like environmental damage
Okay.
that's caused by the company.
So it's not a total shield then.
It's not a complete shield. Yeah.
And what about shareholders? What's their role in all this?
So the shareholders are the actual owners of the company.
Okay.
They own shares, which represent a piece of the ownership.
Okay.
And there are different types of shares.
Okay.
Common shares, preferred shares.
Yeah.
Um, and each type of share comes with different rights,
Okay.
like the right to vote on certain decisions
Okay.
or the right to receive dividends.
Right.
But regardless of what kind of shares they hold, all shareholders have the right to attend shareholder meetings
Okay.
and receive the company's financial statements.
Okay, so that keeps them in the loop.
It does, yeah.
Now, the book goes into a little more detail about the difference between common and preferred shares.
It does.
So can we dive into that a little bit?
Absolutely.
Okay.
So common shares are really what give you that core sense of ownership. As a common shareholder, you benefit from the company's growth.
Okay.
You might receive dividends
Right.
if the company's doing well.
Right.
And common shares may or may not come with voting rights.
Okay.
But every corporation has to have at least one class of common shares that does have voting rights.
Got it.
So there's always someone who can make decisions.
Now, what about preferred shares?
So preferred shares are a little bit different. They're
Okay.
kind of more like debt.
Okay.
They usually come with a fixed dividend payment,
Okay.
which is similar to an interest payment on a loan.
Right.
And preferred shareholders usually don't get to vote,
Okay.
but they do get their money back,
Okay.
plus any unpaid dividends if the company's dissolved.
So they're kind of safer in a way.
Yeah, you could say that, yeah.
Now, when you decide to incorporate, you've got to choose between doing it federally or provincially.
You do.
So in Canada, what are the things you need to think about there?
So in Canada, we've got 14 different Business Corporations Acts, one for the federal government and one for each province and territory.
Okay.
So if you incorporate federally, you might also need to register your business in any province
Okay.
where you have a physical office
Okay.
or you're doing business.
So if you're just selling online, you're probably okay.
Probably, yeah.
So why would someone choose to incorporate federally?
Well, there are a few advantages.
Okay.
One is that a federally incorporated company can operate in any province.
Okay.
Also, the federal government has a stricter process for approving company names.
Okay.
So you get better protection across the country.
I see.
And when you incorporate federally, you automatically get a federal business number,
Okay.
which you need for things like taxes and payroll.
Right.
And then there are some businesses that are just required to incorporate federally,
Okay.
like if you're involved in interprovincial trade.
Right. Yeah.
So it really depends on your specific situation.
Okay. So there are a lot of advantages to federal incorporation. All right. Now, the source material makes a really interesting distinction
Okay.
between the legal structure of a partnership
Right.
and the idea of having business partners.
Yes.
Can you unpack that a bit for us?
Yeah, so we were talking about the partnership as a legal structure.
Right.
But Poulos actually stresses the importance of having partners in the broader sense.
Okay.
Colleagues, mentors, advisors, a strong management team.
Yeah.
That can be really helpful for your business.
So even if you're not a legal partnership, it's good to have a team.
It's really good to have people around you who can support you and offer different perspectives.
Now, one thing that comes up is the idea of minority shareholders.
Yes.
And the source seems to have some strong opinions about this.
Yeah.
So what are the typical reasons why someone might add a minority shareholder?
Well, usually it's to try and keep key employees
Okay.
by giving them a piece of the pie
Okay.
to bring in some outside investment.
Right.
But Poulos is pretty cautious about this.
Okay, why is that?
Well, he argues that the rights and benefits that a minority shareholder gets
Yeah.
are often a lot less than people think.
Okay.
So they might get some basic financial information once a year.
Okay.
They might get to vote on a couple of big decisions.
Right.
But realistically, they don't have a lot of power.
I see.
And, a lot of small businesses don't actually pay dividends.
Okay.
They compensate the owners through salaries and bonuses,
Right.
which key employees could probably negotiate for anyway.
So the idea that you're going to get rich as a minority shareholder
Right.
is maybe not as appealing as it sounds.
Exactly, yeah.
Now, what about the idea of the payday upon sale?
So that's another thing that people talk about.
Yeah.
If a company gets sold, you'll get a big payout.
Right.
But a lot of small businesses aren't built to be sold quickly.
Right. They're built to last.
They are,
So
yeah.
you might be waiting a long time for that payday.
You might be, yeah.
Okay, so what are some of the alternatives?
Well, Poulos talks about something called a phantom share plan,
Okay.
which basically gives you the benefits of owning shares
Okay.
without actually having to buy them.
Interesting.
So you would get a share of the profits if the company is sold,
Okay.
but you don't have to put up any money up front.
So it's kind of like a bonus?
Yeah, it's got like a performance-based bonus.
Interesting. Now, he tells a story about a former VP of sales named Dave.
He does.
And this really kind of illustrates the pitfalls of minority shareholders.
It does.
So can you tell that story?
Yeah, so Dave was really fixated on buying a minority stake in the company.
Okay.
And the owners tried to explain to him that it might not be what he was expecting.
Right.
He wouldn't have a lot of control.
Yeah.
But he was still really insistent.
Okay.
So they even offered him this phantom share plan,
Right.
which would have given him the financial benefits without having to invest any of his own money.
Right.
But in the end, he ended up resigning anyway.
Wow. So he kind of shot himself in the foot?
He did, yeah.
Interesting. Okay, so the moral of the story is be careful what you wish for.
Absolutely.
Okay, so if you do end up having multiple owners,
Yeah.
what's the source's recommendation about shareholder agreements?
He says that having a shareholder agreement is essential
Okay,
if you have more than one owner.
really important.
Yeah, it can save you a lot of headaches down the road.
What kind of things does a shareholder agreement cover?
So it covers things like how decisions are made,
Okay,
how shares can be transferred,
okay,
what happens if someone wants to leave the company.
okay.
It can also include things like a shotgun clause.
A shotgun clause? What is that?
So a shotgun clause is a way to resolve disputes
Okay,
where one shareholder can basically force the others to either buy them out
okay.
or sell their shares to them.
Interesting.
There are also things like piggyback clauses,
Okay.
which give minority shareholders the right to sell their shares.
Okay.
If a majority shareholder is selling
Okay.
and drag-along clauses, which give majority shareholders the right to force minority shareholders to sell
Interesting.
if they find a buyer for the whole company.
So it's all about protecting everyone's interests.
Exactly.
What about financing?
So the agreement might also cover things like
Yeah.
how much debt the company can take on,
Okay.
or whether the shareholders have to contribute more money
Okay.
if the company needs it.
Got it. So it's very comprehensive.
It is, yeah.
Now, the book does mention one potential downside to a shareholder agreement.
Yeah.
What is that?
So if the agreement limits the power of the directors too much,
Okay.
the shareholders could actually become liable for some of the company's debts,
Oh, wow.
which kind of defeats the purpose of incorporating in the first place.
Yeah, that's kind of ironic.
It is, yeah.
Poulos tells this story about a sales manager who almost held up a company sale
Oh, yeah.
at the last minute
Yeah, he wanted more money.
just to sign the papers.
Yeah.
Wild.
It just shows you how important these agreements are.
Yeah, you never know what's going to happen.
You really don't.
All right, let's talk about holding companies.
Okay.
So the book really recommends owning shares in your operating company
Yes,
through a holding company structure.
it does.
So why is that?
Well, there are a few advantages.
Okay.
One is that it gives you more flexibility
Okay.
when it comes to things like different classes of shares.
Okay.
So you could have voting shares and non-voting shares.
Right.
It also gives you more flexibility with how dividends are paid.
Okay.
And there could be some tax advantages.
Okay. How so?
Well, dividends can flow tax-free between companies within the structure.
Okay.
So you only pay taxes when the money is paid out to the individual owners.
I see.
And then there's also the benefit of asset isolation.
Okay. Talk about that.
So if one of your operating companies goes bankrupt,
Right.
the assets that are held in the holding company are protected.
Interesting. So it's like a firewall.
It is, yeah.
So that's a big advantage.
Yeah, they can really help to minimize your risk.
Now, obviously, setting up a holding company is a bit more complicated.
It is.
So what's the advice there?
Definitely talk to a lawyer and an accountant.
Okay.
They can help you make sure that you're doing it right.
Okay. So we've covered a lot of ground today.
We have.
From the very simple sole proprietorship to the more complex world of corporations and holding companies.
Uh-huh.
So what's the key takeaway here for our listeners?
I think the most important thing to remember is that choosing a business structure
Yeah.
is a really important decision.
Right.
And it has big consequences for your personal liability.
Right.
So while a sole proprietorship or a partnership might seem easy
Yeah.
if you've got assets to protect,
Right.
incorporating is usually the best way to go.
And for those who do incorporate and end up with multiple owners,
Get a shareholder agreement.
absolutely.
It's so important.
Yes. And for more established businesses,
Think about a holding company.
yeah, definitely something to consider.
It can give you a lot of benefits.
So now that you understand the basics,
What are your next steps?
what are you going to do to protect yourself and your business?
Think about it.